All right, let's dive right in. Today, we're going to talk about something that trips up so many traders: support and resistance. We're going to move past just drawing simple and, let's be honest, often frustrating lines on a chart. Instead, we're going to build a professional, rule-based system for finding the exact zones where the market is most likely to make a turn. Sound familiar? You spend all this time finding what you think is a perfect level. You draw your line, and then you just watch as the price either smashes right through it or, and this one's even more annoying, it reverses just a few pips before it even gets there. This isn't just bad luck, you know. It's a huge sign that we need a much better, much more precise method. So this is the big shift in thinking we need to make. The old way, using a single subjective line, it's just not reliable. The professional way is to think in zones. Instead of guessing one specific price, we're going to define a high probability area where the market is likely to react. And I'm going to show you a clear, totally mechanical way to define these zones every single time. Okay, so here's our game plan. First, we'll quickly cover why single lines let us down. Then, we'll build the core method for defining ranges. After that, I'll show you a really cool test to make sure you're on the right time frame. Then, we'll get into decoding the different types of pivots, and finally, we'll pull it all together into a simple framework. Here's the real problem, right? The market isn't a single point. It's not a laser beam. It's a messy, dynamic auction, a battle happening across a whole zone of different prices. A single line tries to act like it has this pinpoint precision that just doesn't exist in reality. And that's exactly why it so often fails. We need a tool that actually reflects what's going on. And that leads us straight to our core technique. We're going to learn exactly how to mechanically define a pivot range. Now, this isn't about squinting at the chart or guessing or eyeballing it. Nope, this is a simple, repeatable process that is the foundation for this entire way of looking at the market. And honestly, it's this simple. You find your pivot candle, the one that makes the highest high or the lowest low in that particular swing. Your first level is the absolute tip of that candle's shadow, or the wick. Your second level is the open or the close of that same candle's body. Just pick whichever one is closer to that first level you drew. And that's it. You've just created a precise two-level range, and you've taken all the subjectivity out of it. Okay, so we've drawn a range, but how do we know if it's actually a valid one? Well, we need a measuring stick. And our measuring stick is the ATR, or the average true range. If you're new to it, all the ATR does is measure the average volatility for whatever time frame you're on. It basically tells us, hey, what's a normal-sized price move for this chart right now? And this is absolutely crucial for our next step. Now, this right here is the golden rule for validating your zones. A really good high-probability range should be about half the size of the current time frame's ATR. So after you draw your range, you measure it. Let's say the daily ATR is about 60 pips. You're looking for a zone that's somewhere around 30 pips. This little check keeps our analysis totally grounded in the market's real-time volatility. But what happens when your range doesn't fit the rule? What if you draw it and it's way, way bigger than half the ATR? Well, that's not an error. That's actually the market giving you a massive clue about who is really in control of that price level. Think of this like an alarm bell going off in your analysis. When your range is way bigger than 50% of the current timeframe's ATR, that's a signal. It's telling you that the pivot you're looking at, well, it wasn't created by the traders on this chart. It actually belongs to a higher timeframe. Let's walk through a perfect example to make this crystal clear. Say you're on a daily chart and you draw a range that's 72 pips wide. You look down at your daily ATR indicator and it's only 64 pips. Well, your zone is way bigger than half the ATR, right? It's even bigger than the whole ATR. So you pop up to the weekly chart. You check the weekly ATR, and it's 165 pips. Half of that is about 82. Your 72 pip range fits perfectly inside that. Boom. You've just used this test to confirm you're looking at a major weekly pivot, not some minor daily one. Okay, so now we can define a range, and we can validate which time frame it really belongs to. The next layer to this professional analysis is understanding that not all pivots are created equal. We can actually classify them by their strength and their purpose, and that tells us exactly how we should approach them. First up, we've got the weakest of the bunch, the pullback pivot. This happens right after a big level breaks. You'll see price make a quick, kind of shallow retest of that broken level before it continues on its way. These are really low probability spots to try and enter a new trade because they fail all the time. Honestly, their best use is just as a small initial target to take a little bit of profit off the table. Next up is the purification pivot. This is the very first time that price comes back to a significant level after a big move away from it. Its purpose is to purify the market, so to speak, to clean out all the early birds and shake out the weak hands. This is not the A-plus entry just yet, but it is a super important area where you need to be paying close attention for signs that a real turn might be starting to form. And finally, we have the one we are all hunting for, the reverse pivot. This is a strong pivot that forms on that main, higher time frame we identified with our ATR test. This is the institutional footprint. This is the level where major trends are born and where they die. The key takeaway here is that these are the absolute highest probability zones on your chart, and this is where you should be focusing all your energy to plan your best trade entries. So let's pull all of this together. We can basically summarize this entire system into a simple little cheat sheet that you can use for your analysis every single day. Here's how the framework looks in action. You see a pullback pivot? You think weak. It's best used as a minor profit target. That's it. You spot a purification pivot? Okay, medium strength. This is an area to watch closely for confirmation. But when you find that strong reverse pivot, that's your A-plus setup. That's where you should be planning your high probability entries. This simple classification just brings instant clarity to what you're seeing on the chart. All right, to wrap it all up, here are the absolute key takeaways. First, ditch the single lines. Start trading using these mechanically defined ranges. Second, always use the ATR as your measuring stick to make sure your ranges are valid. And remember, an oversized range isn't a mistake, it's a huge clue pointing you to a higher timeframes control. Then, prioritize your trading at those strong reverse pivots. And as a final little practical tip, when you do plan a trade, think about using the first half of that zone as your entry area and place your stop loss just on the other side of the second half. With this framework, you're not just looking at random zigzags on a screen anymore. You actually have a method to read the market's story, to understand the strength of a level, and to see who is really in control. So the final question to you is, when you go back to your charts, what story are the pivots telling you now?